Hello, everybody. I am back with a new interview. I have not interviewed any business in a few months. We started these right at the beginning of our initial lockdown, and so much has changed in the real estate industry this entire summer. And there's some great new opportunities in the mortgage world, which is why I have with us today Claudio Pernotto with Preferred Rate. And Claudio is our in-house lender. He represents all the agents for our three offices, which is approximately 90 different agents. And so we have a very good working history with Claudio. We've worked with you. How long have you been with our offices?
Oh God, I feel like it's been 4 or 5 years. Right now, it's gone so fast. It's hard to actually backtrack on it, but it's been a while. So it's always been it's an ongoing good thing. I mean, I don't if we weren't doing what we were supposed to be doing, I don't think that we'd have the response from all the agents and the way that our team operates and stuff. So it's very fun. And it's also, we get the job done. I think that's the main thing is, putting people in homes is what we do, and we do a good job at it. And that's why we're around for this long. I think that stands for itself.
Well, and the thing before we get into our topic today, just a little bit more about you so people understand, people haven't met you yet. And, you have a whole team that works for you. I know that you even have a Spanish-speaking individual on your team, which Caitlin has referred clients to. I think you're working with a client right now for her. Just a little bit about how long you've been in the industry and a little description of your team.
Yeah, I've been in the industry for about 16, just over 16 years. To develop a team first, clearly when I started out, I was able to do everything myself, but as a team as I developed and started becoming, I like to think that I'm good at what I do, right? Or also I wouldn't have a team. I don't think I would, but, Maria, my loan officer assistant, she's my assistant who's, dedicated to me to help get the pre-approvals done, the front work going, gather all the documents to complete the pre-approvals. So we make sure 100% that when we say that someone is approved to purchase that amount for a home, that there aren't any glitches in the process where, because our buyers are putting money up front before they even submit the loan underwriting and things like that. So those are the things that make us successful, where when we tell someone or give them a pre-approval letter that they're going to purchase a home at that price and they submit that offer, that we're going to close on that home for that amount. That's the track record that really makes people successful in this industry. Then I have my processor, Dawn Ikovic, who handles from when the underwriting approval comes out and the appraisal comes out. She reaches out to the buyer and everyone who's involved in the loan process of the purchase, I should say, and collects all the conditions to submit back for final. Make sure that all the documents are signed for TRID. Make sure that we get the homeowner's insurance established, because those are the intricate pieces that help achieve our clear to close, or our commitment date, which is so important. So, and then we have Maggie, who is, my Spanish speaking teammate, who, for me, it's hard to tie myself to someone if, been doing it for a long time, but I've known her for so long. She's great at what she does. And I know that Caitlin has used her, and a lot of people in the office have used her too. So it's good to have that kind of complete package, per se, to offer, to cover every angle or every facet of the industry,
Good. All right. Well, we're going to get to our topic here because I want to try to keep this within about 5 minutes or so. We don't want to lose any of our viewers, but the information is so good, you guys. You brought this up the other day that you guys are doing 203K loans. The last time I had a client use that program, I think was like 2009 or 2010 on a foreclosure property that they purchased. Can you just give us a brief little, general concept of what kind of loan that is?
Okay, it's an FHA 203 K rehab loan. It's a non-structural rehab loan. Okay, so it offers the buyer the ability to purchase a home that's not in the greatest of shape. Okay, but nothing structurally. All right, where you are able to get a contractor and do the work into the home, and the appraised value. There's the two appraisals: what the house is worth when you know what you're purchasing it, and with the improvements, what it's going to be worth after. And that's where the loan is structured after the fact, where you're able to get the loan amount to cover all the repairs and contract work done after. Okay.
Good. And is there a large percentage as far as down payment on that, or how does that work?
It falls under the FHA guidelines. You do 3.5% down. Okay. Which is excellent, you know, and credit scores. A lot of people ask you, what are the credit scores? Right now for this program, it's 640, but we believe that it's going to start, you know, lowering back down to where we were at 600 before this COVID started, because it's kind of like it bumped up the levels. On a regular FHA loan right now, I'm able to do 600 for a purchase. Okay. Same thing with a refinance, but on the 203K loan, because there's more involved, there's contractors and everything, they feel that right now it's 640 is the number, but we feel that by the beginning of next year, that's going to drop down also, like kind of match the regular purchase FHA loan.
And is the interest rate still within like the general range that we're seeing, or is it a higher rate for this, or?
It's no, definitely the same interest rate, you know, so that's another plus to it.
And can it be used for an investment property or only for your personal residence?
These loans are basically your primary residence. They will not allow them to be your investment property. You're going to be living in it. FHA in general has always been a
Right.
A primary residence loan, but
And
not, you know, you could purchase a home FHA, and you know, as time goes on, you know, you can move out of it and still keep that house, and it can turn into an investment property by you purchasing another primary residence. Now, you cannot have two FHA loans unless you're, I believe it's 100 miles away from one another. That's like the rule with FHA. So you can't have two FHA loans as long as they're more than 100 miles away from each other. So another state, I've had that happen. So you know, you're moving from one state to the next. You can get another FHA loan when you're that far away.
all right. And I think a lot of people, I know this from the past, you know, back from the Great Recession, when there were a lot of foreclosures, there were a lot of people looking into, you know, where am I going to get funds to rehab a property? And the 203K loan was a logical step. But, you know, I think people, they thought it now, and I'm sure they thought it then, I'm sure they think it now is, well, heck, I'm handy. I could do this work, and I could do it for half the amount that, you know, a contractor would charge, but that's not really the case, right?
Right. That's probably the most misleading part of the FHA or any of these rehab type loans, is that, you know, I can't tell you how many people say I could do this, or my uncle could do it. My family member is great. He's a plumber. It's as soon as we tell people that, it kind of takes the wind out of the sail a little bit, but they have to understand that the bank, the investor, does not want a friend or a family. It has to be a licensed contractor to do the work, because all in all, it's really not your property until you finish paying for it. The bank wants to make sure things are done, you know, legally and legit, you know, permits and whatnot. So licensed contractors that are familiar with the 203K rehab is very important to make it a smooth transaction, because on my end, the loan is just like a regular FHA loan. It's the investor that we're bringing in, the contractor, not the investor, but the contractor coming in to do the work is the outside piece that I can't control. You know, you have to find your contract. And there are, I think if you go to Home Depot, believe it or not, has contractors that are listed that will do 203K work and are familiar with it. So, you know, you can inquire with your local Home Depot or even Menards and find someone, and you have to take the time to pick the right contractor, because we have nothing to do with that.
That's so cool. I didn't know you could get that through such an easy resource like that. And I did remember in the past, like when they write up the scope of work, there's a certain way that it needs to be submitted. That's how FHA wants to receive the scope of the work that's going to be done, right? And that's why you're talking about they
Right.
have to be familiar with that process. Does the contractor have to be registered in a certain way or?
Well, he's got to be licensed, bonded. He has to be in that aspect. Yeah, but like is registered like a 203K registered?
Right, like that they
I
know the
don't know.
guidelines?
No, I just think it has to be a contract, 203K contractor that is, and I'm sorry,
Okay.
to a regular contractor who's familiar, with doing that. I mean, I'm sure that someone who's not 203K, who hasn't done it before, can do it.
Okay, all right. And then we segue over into, you just let me know of this when we were kind of prepping for our video here, was the Home Styles loan, which you said is conventional. And can you tell me just kind of how that compares to the 203K then? And who would that be good for?
Okay, that would be good for anyone that is looking to go into the conventional format instead of FHA, because there's different criterias between FHA and conventional loans. We can get into that too, but I think that the home style is if you're able to qualify for the home styles, the thing I think that separates them the most is that the 203K, your ratio limits are higher. Like you could qualify for more debt to income ratio for an FHA loan. Okay, so there's some pros and cons to it. If you are credit score, if your credit score is a higher tier, let's say, you're almost better off, and if your debt to income ratio falls with a limit, you're almost better off going conventional because your PMI payment factors in a lot with the conventional loan. So it's a matter of putting it together and seeing which loan fits them. Just like I would do on a regular pre-approval, we want the best payment for our buyer, right? And make the smart choices for that particular situation. And, like I always offer with my first, anyone that closes with me on a purchase is that, we may have to get into a house as an FHA loan, but I offer a free refinance for the life of the loan. As long as you're in that home, you could refinance. So it puts us in a position to go in FHA, and then our ultimate goal is to get into a conventional loan. We can do that after the fact, after the improvements are done and the equity is in the property already. So
That's
there's
fantastic.
some things, and if the buyers want to contact me, we can talk and discuss that in detail. But it's basically what we discuss on pre-approvals. Okay, which program is going to work best for that?
Well, that's good. You're not just throwing out, here, this is for you. You're doing more of like a holistic approach, really getting to know the client, understanding, what their needs are, and really address each one individually. On the home styles, is that also just for your primary residence? Is that the same?
Yes, it is.
Okay.
It is.
All right. That is fantastic. So I know we've got people out there who, really wanted to buy a home this year. Maybe they had a bump in the road this year because of COVID, a little income drop or something like that. And they see these homes they look like they're in their price range, but then it turns out they need all this work and they don't have cash on hand to just go to Home Depot and, put it on your credit card or write a check or whatever you're going to do to pay for it. This could really make the difference between somebody having to wait indefinitely to buy a home, as opposed to now they can seize this opportunity while the interest rates are low. They can get that loan that's going to help them finance their projects. That's fantastic. It makes home ownership available to a lot more people, I think.
I agree. I mean, where the interest rates are right now, to get a home and be able to do the work and fix it up at the interest rates where they're at right now, it's crazy. I mean, and definitely you can own a home like that and pay less for it than you would if you were renting. And doing all that. I mean, it's crazy how much I mean, I joke around a lot saying it's like free money. To me, these interest rates. I don't know how long they're going to be around, but I would have thought like way back before COVID happened and all this, that interest rates would have been higher. Here we are, we're still in the high twos, low threes, depending on like your situation or whatnot. But it's incredible. It really is. Great opportunity for a lot of people to purchase something right now and take advantage of the seize the moment, I guess, right? Seize
Yeah.
the moment.
It's certainly a silver lining in all that's going on in the world right now. So anybody who is interested, we are going to put contact information for Claudio here in the video or in the post. And you can also post questions below the video, and we'll make sure Claudio gets those questions so we can get them answered for you. But don't miss this opportunity. 2020 is totally a great year for you to just go ahead and make your purchase. And I am going to stop our